All right, guys. Good morning. So today, we're going to take things a step further. Okay. This is the last market we're looking at. Okay, so you can see that I said we have to wait. We have to wait to look at this, right? So you can see this is the last valid swing. All of this is, we're still waiting for a pullback to be taken, right? And I explained something to you. I said the pullback is, see, this is a valid pullback, right? Why? Because this is the lowest candle. Look at it, right? This is the lowest candle, right? When the high of the lowest candle is taken and the market makes a new low, you have a pullback. When the high of the lowest candle is taken in a downtrend, this is the low. You see, this is the lowest candle. If this blue one was the lowest candle here, all these ones, it will not be a pullback. This will just be, all this will just be an inside bar, right? This will just be an inside bar. But the lowest candle here is this guy, right? So this is the lowest candle. This is the high of that candle. This next bar has exceeded that high, right? The next bar has exceeded that high. And now, after exceeding that high, it shows you that the market has gone deep and the market is making a new low, right? That's why I said the low of the candle is taken out, right? The lowest candle, I beg your pardon, is, the high of the lowest candle is taken out in a downtrend. High of the lowest candle is taken out, right? And the market makes a new low. Then once this level is taken out, we can now say, okay, this is a valid swing level, right? So you need to understand what it means to say that this pullback is valid, so that you can correctly say, okay, this is a valid inducement. All right, all the pullbacks that we said that were actual pullbacks, why we called them actual pullbacks was because they met this criteria in the downtrend. Look at all the pullbacks. This is the lowest candle. Immediately the market pushes beyond the lowest candle, right, and makes a new low. That place becomes a valid pullback, right? Look at this one. Look at this one here. Market pushes. This is the lowest candle, right? You see, this is the lowest candle. The next bar goes higher than it. So this is, the market is coming down. This is the lowest candle. Market pushes beyond it and makes a new low. It means that this place is a valid inducement. Okay, take note of that, right? I think I've explained that enough. All right, same thing here. Lowest candle here. Market pushes beyond, the next bar push beyond the lowest candle and the market comes down, right? So it pushed beyond and makes a new low. If you compare this now, you see that this is a new low. So here is a valid inducement. We're going to use it going forward, right? So you need to understand it. Okay, this I'm just introducing you to the concept for now, right? So here we're looking at we're looking for the valid pullback. The valid pullback is, see the highest candle. This is an uptrend now. In the downtrend, I said the high of the lowest candle is taken out. In an uptrend, the low of the highest candle is taken out and the market makes a new high. Once the low of the highest candle here, this is, you can see this is the tallest, right? Compared to the other ones, this is the tallest, right? And this is the low of that candle. The market was going. It got to this high and then it came back. The next candle held and closed below that place, right? And then started resuming higher. It means that this is a pullback. It's valid. All right, it's valid. Take note of what I said. It's valid. Which is the highest candle here? Is this white one, right? The white one is the highest candle. Okay, now after the highest candle, market starts to pull back. This is the low of that candle. Is it taking out? Yes, it's taking out, right? And then after it was taken out, the market pushed higher to make a new high. So this is a valid inducement area. So what are you looking for? You want to see the market come back to tap into this area and then push higher, right? So that's the same thing here. This is the highest candle. This is the low of the candle. This wick here took it out, right? There's a wick there. It took out this low. Okay, there's a wick here. It took out that low, right? After taking out the low, market push higher, right? It push higher, making this a valid pullback. So this is a valid level, all right? So on and on like that, right? So I told you, gradually you're going to get it, okay? So just stay with me. Let's keep going, right? Because most of the information here, they are actually the very valid way to look at most of these things, okay? Because we cannot say let's use 1 bar. We cannot say let's use 2 bars. We cannot say, okay, anytime you see 3 bars is a pullback. No. We cannot say anytime you see 5 bars is a pullback. No. We cannot say, okay, if the market pull back 10% or 20% or 30% or 40%. No. There is actually what makes a pullback valid, and that's what I just showed you. All right? So here you can see here we have a valid pullback, right? We have a valid pullback here. Let me bring that thing down there, right? So here you can see we have a valid pullback. Okay, why is the pullback valid? The same rule applies, right? The same rule applies here. This is the lowest candle. The market pushes higher than that lowest candle and makes a new low. It makes this level a valid inducement area. What are you looking for? What are you looking for from here? You're looking for the market to exceed it. When the market exceeds it, the market has not exceeded it yet. If this market continues to go down, we know that here we have an inducement. If it continues to go down, it means that this one too will be a valid inducement. Why? Because this is the lowest candle. The low has been taken. If this market now continues to go down, if it continues from here and it goes down like this one will be another inducement. All right? If it does not continue to go down, if it doesn't continue to go down and then it reverses, meaning that it takes the next candle continues up and takes out this level, I'm going to now say, oh yeah, I have a valid, lower low there, right? I have a valid lower low. Now my work is, if there's no reversal, right? My work from this point is, how can I continue the downtrend? So what I'm looking for is the extreme area. The extreme area, once the market continues, goes. Once it gets to this last point, right? I want to sell. Once it gets to this is the last inducement here. This is the last valid pullback. If this market goes up to this point, it's time to sell. If you get stopped out, you get stopped out. It's valid. It's a numbers game, but it's valid, right? It's valid. Why? Because we have a level here. We have a level here. This is the extreme. This is your engineering liquidity. This is your line of defense. This is your line of defense. This is your swing level. That's your swing level. This is your extreme liquidity. If the market has news, if prior to when this level will be triggered, there's been a news, there is a tendency of the market to tap into the extreme POI with a wick. It won't close beyond it, right? And then it will fall. It's possible. So I'm telling you so that you prepare for it, right? And then what is it tapping into? Look to the left. You must see something. You must see something, all right? You must see something. If you look to the left, you see something where it is likely going to tap into. All right. And then if the market taps into this, right? If it taps, we don't expect anything more than a reversal from that point. Okay, so that's the thing. Now, if the market is approaching this inducement and there is no catalyst, there is no news to drive volatility, I don't think you're going to have enough power to break this, the swing, line of defense. But if there is news, what you want to check is two things you're going to check to know if your swing level will hold or not. Right? To know if your swing level will hold or not. Number one, is there news? If there is a news, the market may tap into this level and reverse. Right? I showed you yesterday on the AUD USD, right? Market will tap. There was news, right? There was news. So this is supposed to be a line of defense, this one. But because of the news, what did the market do? It tapped into it and reversed. And where did it tap into? Look to the left. You see it. Those are the two things. If there is news and if there is actually a valid POI, I'm going to touch POI today. If there is a valid POI here, whether order block, whether supply, whether demand, whether anything whatsoever, right? If it is there and it is valid, the market can tap into it before going down. So you need to take a look at your swing level, right? You need to take a look at what you're looking at. All right, this is not actually a swing level here, but I'm sure you get what I'm trying to teach you here. Okay, so if you have a swing level, usually your swing level should not be taken. This is a valid swing level because we have a pullback here. This is the lowest candle, high was taken, makes a new low, and it has been breached. Market makes a break of structure. So what? We have a valid level here. This is a line of defense. This is our last level, inducement, last pullback. So what do you want? You want the market to come up all the way to the extreme level, tap into this last one, tap into your other block, and reverse. If there is news, you expect the market to tap into the POI to the left, right? The POI to the left. Once the market taps into it, right, it will bounce. It will reverse if there is news. All right, so you need to take note of that. Okay, so you can see we're almost done. The only thing I need to show you is, the entries, how you can enter, how you can actually enter. And then we go forward, we talk about trade management and all those things. So the last part of what I'm going to teach you regarding the concept is the point, the price of entry, the POI. That's the last part. Once I teach you that part, you have a strategy in your hands. And then all you need to do for me is, what are the 3 things I want to see? Or what are the 4 things I want to see so that I can buy? What are the 3 things? I want to see this, I want to see that, I want to see that. When I see them, I will buy. That's all. Right? I want to see a valid swing. I want to see, you want to know what you want to see. Right? Once you know what you want to see, you now go to your chart and backtest it for at least 1 year or at least 100 samples. You want to see how the trade performed 100 times. And I'm not saying you should be skipping all the ones where it did not work. Include the ones where it didn't work, where it failed. In this example, imagine that the market comes all the way back, right? Market comes all the way back. It doesn't hold. It doesn't hold. It doesn't hold. It stops you out. Continues uptrend. Right? This would have been a valid entry. You were stopped. So you take note of it. Right? You take note of it. So, but what we are saying is the chances of how many times this is going to happen? How many times? Right? How many times this is going to happen? That's what you want to take note of. And then the idea here is, the good thing with what we're sharing is your reward is always very good, right? So even if you get stopped out, or you have good risk management, if you get stopped out on this trade, even if you get stopped out 7 times, if you win only 3 times, you'll be in profit. If you win only 3 times, this trade here is about 1:7. Even if it's 1:5, if you win 3 times, you have 15% profit. If you lose 7 times, you have how many? You have minus 7% profit. So what does that tell you? It tells you that once you get your entries right, once you get a good trade, you will cover up for all your losses. So what does that also mean psychologically? It means that you need to have the stomach to take a lot of losses. Otherwise, you can't trade these patterns. You need to have the stomach to take many, many losses. Is that okay? So that being said, I will let me look at the community. Okay, I think I have something on psychology. Okay, so what's the possible way? Yeah, so I asked him to. He sent me this to my WhatsApp, so I asked him to send it here. Every question you have regarding emotion, psychology, try to keep them here. All right, try to keep them here. So that I can take care of them. I'm going to come back to answer the question elaborately. But in the meantime, he's saying that what possible way will I apply to myself so that when I'm holding a bias, if I see someone's chart, it won't change my mind from my own chart. Yeah, so the truth is, you before you look at somebody's chart and it affects your bias, it means that you don't have the proper amount of confidence in what you are doing. All right, you don't have enough confidence, and the only way you can get confidence in trading is to backtest your rules. So I said, okay, what are the 3 things you want to see on a chart, right? If you want to see valid swing, break of structure, or whatever inducement, and maybe an order block or something, these are the 3 things you want to see. You go and backtest it. 1 year, 2 year, 3 years. I have 12 years backtested data. 12 years. And I'm still going because I'm trying to cover all the pairs. So I'm telling myself, okay, I backtest for at least 1 hour every day. It's a routine. If you see me take any trade, I have backtested that. Any pair, I have backtested it. All right. So you're going to run your backtest. When you do that, you will see that the strategy works. That's the first thing. So there's nothing anybody going to tell you, and there's nothing you're going to see anywhere. You know what you want to see. You know what is when you lack confidence in what you're doing. That's when another person's bias will affect your own. All right. But this is generally called recency bias and confirmation bias. Okay. When we get to psychology, I'm going to teach that, right? I'm going to talk about it. Recency bias is because you took a loss in your previous trades, you now come into the new trade, you're scared to take it, or you trade wrongly because you have been taking a lot of losses, or because you have been winning all your trades, you come to the next trade and you increase your lot size, or you don't put a stop loss, or you just don't do the right thing. Why? Because you have some profits, you have been winning your past 3, 4, 5 trades, right? It's called recency bias. So you need to neutralize yourself before you take every trade. That's why we advocate for meditation and journaling and all these things, because you need to clean your slate. Confirmation bias is somebody tells you, oh, this week dollar is going to crash. So you open your chart, all you see is dollar crashing, right? So that's a problem, guys. That's a problem. So you need to clear all those bias and focus on your own execution rules. What do you want to see on the chart? When you see it, you execute. Regardless, it's a numbers game. Execute. Right? You don't set goals in trading. You don't set goals. If you want to set anything at all and call it a goal, it has to be process-based. So if you're setting any goal, it must be process-based goals. So you can't come and say, okay, I'm going to make this money, I'm going to make that money. No. Your goal is to follow the process. How am I following the process? I'm going to ensure I do this on the next trade. I'm going to ensure I do that on the next trade. I'm going to manage my trades like this based on what my data has given me. Okay. All right. So I think I have a more assignment here. Okay, just one more. What's this? Okay, I'm seeing some. So okay, so that's actually correct. That's actually correct. It's still a trend line. Liquidity, you can see money was being, some people were thinking the market will reverse here, so they had their stop loss here. Market pushes up, taps into their stop loss, pushes again. Some people put their stop loss here, it taps into it, it pushes again. Some people put their stop loss, it taps into it, it continues like that, right? So the trend is down. You're trying to buy. You're gonna keep getting whipsawed, and then you ruin your account. Okay. So what do you have here? Okay. So same thing, right? Stop loss. People thinking the market gonna sell. People thinking the market gonna sell. It keeps stopping them out. They think it's gonna sell. It stops them. They think it's gonna sell. It stops them. Think it's gonna sell continuously like that, right? And then all the people who say, okay, it's now a reversal time. We're going up. We're going up. We're going up. They are entering, buying pullbacks, and what happens? Piam, everybody is gone. Okay, so these are all liquidities. I'm happy to see this. This is double top, right? This is double top. I cannot see what is there, but I think it's yeah, correct. That's a double top. Double top is a liquidity pool. Is often called equal high liquidity, EQL, EQH or EQL. That's equal low, equal high. Okay, I'm happy to see this. It means that people are coming up to speed with what I'm teaching. But most importantly, I need you to understand how to mark a valid structure, because it's an important ingredient. It's an important ingredient in our setup. All right, you need to be able to mark the structure correctly. Go back to the video, go back to the example. All right, go back to the example, and then try to mark it correctly. Let me introduce POI today, guys. Going forward, I'll still keep on teaching you. Of course, while we start trading, while we start taking the entries, you still see me emphasizing or teaching more about swing structure, but I don't want the course to be too extended, right? Because I'm tempted to take another example on market structure. So, but I'll move forward, okay, so that the course does not get too ambiguous. All right. So let's continue, guys. Let's continue. I'm gonna look at POI. All right, and POI or AOI is just more convenient to say POI, right? So POI is price of interest or area of interest. Okay, so it's the area of interest. Area of interest. Remember what I told you? I said, okay, the market pushes, gives you a valid pullback, right? Gives you a valid pullback. Now you have a swing, right? You have a swing, right? You have a swing. You have inducement, you have engineering liquidity. Now, when the market starts to pull back, traders are looking for where they want to join. So that place where they want to join is referred to as the POI. Okay? Whatever it is referred to as the POI. All right? So, but like I said, once the market gets to the engineering liquidity, it may not get to your POI. It will resume. It may not get to your POI and it will resume. Now, what I teach is what you need to do is to avoid getting missing that trade, right? But this is advanced stuff. You don't enter with, there are two ways you can enter a trade. You can enter with LSI, or you can enter with DCA. LSI is lump sum investing. And I did not manufacture this thing, right? These are real word, right? These are real things, right? You can check them out. Okay, and then you have DSA, right? DSA is the dollar cost average, right? Averaging, right? So the dollar cost average is you know what you're saying here is very simple. You're saying I want to be entering small. I want to be entering small around my area. All right, around my area, the area where I'm interested in getting in. I want to start with the smallest position, 0.01. I want to start from there, right? I want to start. Now, as the market continues to go lower, before it gets to the area where the trade is considered to be invalid, I was saying something. I said, retail traders have a lot of work to do, right? Because for you to be a trader, if you're a trader, as a company, you're going to have an analyst, right? You're going to have an analyst. You're going to have a risk manager. You're going to have a psychologist, right? You're going to have the actual trader, all right? The analyst is the person who is going to tell you this is your TP and this is your stop loss. That's his work, right? That's his work. I'm sure you know what these people do. The analyst will tell you this is your TP, this is your SL. The trader will do what? The trader will get a good entry. Trader will get a good entry, the best entry that will give him the best risk to reward. That's the trader's job. So if the analyst comes and tells you, okay, this is the range we are working with, right? This is the range we are working with. You know, he comes and says, okay, pullback is taken. Now, the analyst will tell you from here to here, right? From there to there this is your SL, this is your TP. It is the trader's job now. It's the trader that will now say, where am I going to enter for me to get the best risk to reward? And this is what I've been teaching you since. Right? This is what I've been teaching you, the same thing. So you just need to know what is my buying range. In this case, we have an uptrend. What is my buying range? If it's a downtrend, what is my selling range? Your goal is, how can I get in early, cheap? Right? Because I see a lot of traders say they miss an entry. Lump sum investing, as the word goes, is you just say, okay, what am I going to risk on this trade? I want to risk 0.5%. Right? I want to risk 0.5%. If I want to risk 0.5%, if 0.5%, if I have a 100K account, 0.5% is $500. I'm going to say, okay, where is my order block, right? Where's my entry? What's my price of interest? Where's my order block? I'll now say, okay, order block is here. I'm going to teach you what order block is. It's a candle where you expect the reversal to take place. Then what the trader is going to do, they're going to come to the order block and say, okay, from here to here is 8 pips. That's my stop loss. 8 pips. I want to risk $500. Now, for me to risk $500 on 8 pips, maybe I need to use about, let's say, let's call it 7 standard lots. Right? 7 standard lots. Right? So he needs to use 7.0, right, to place this trade. He uses all his 7.0 at once, puts it on the order block. The good thing here is, if this money moves from here to here, right? If the trade gets triggered and the market moves up, he's going to get about, let's say, 1:5. Right? He gets 1:5. It means that he has gotten how much? $2,500 from this trade. Is that okay? The other person is the DCA guys. The DCA guys will now say, okay, no. Sometimes the market will come into this engineering liquidity, right? The last area of inducement. You know, it will come there, trigger it, and go without getting to the order block. It won't get to the order block. This is when the traders say they get a missed entry. All right. So what do you do, guys? So you set your alert. Set your alert here, around the inducement. So I'm going to now set that alert, and then I will say, okay, this is inducement on H4, right? Inducement on H4. So once the alert rings, I'm going to open that chart and look at it. From that point, I'm now interested in buying that market. So I go to M15 and look for change of character, and then I try to buy. Is that okay? Now, what I'm saying is this. The market may react from here. Market may react. If the market reacts with a wick and does not come back, you should buy. It means that the market is not interested in mitigating the order block. It's not interested in mitigating the order block, right? So you can buy. Now, do you buy with all the money, all the $500? No. If $500 7 lot, you can't buy with all the $500. You have to break this $500 down. You can break it down into 3 places, right? Depending on how many things you are seeing here. Depending on how many things. Most likely what you have is the area of the inducement, right? First place. The second place, you have what we call imbalance, right? The fair value gap, right? 50% of it. You put the second one, all right? And then the last one is the actual order block, right? The source of that thing. These are usually the 3 places where you're going to find the entry. Now, what is this going to do for you? What's this going to do for you? See, if you use 1150 on each of these trade, you are risking less. That's the essence of DCA. DCA makes you risk less, right? See, what I mean is DCA makes you risk less. DCA is for people who are more interested in protecting their money. All right. So see what you're going to now observe. Now let's say the market triggers this one. This one will be in loss, right? The market gets to the other order here. It will trigger this one. The lot size here is, see, if from X here to the swing low is 8 pips, right? Because X is the highest, which is the inducement area, that engineering liquidity. And the order block, what is at the extreme of the order block is your swing, right? Is that your swing where you have your line of defense? Now, let's say from here to here, including the extra 2 pips you're going to add, or 3 pips, will now make everything 10 pips, right? Let's assume you're working with 10 pips. The first one, which is X, will have, you will say, I want to risk $150 for 10 pips. I want to risk $150 for 10 pips. Now, you're not going to use all 7 lot size. Neither are you going to say, I want to use all the 7 lot size on the other block. You're going to say what? I want to, now see what I'm saying. If the market is like this, right? I want you to get it. If the market is like this, see, you're going to have fair value gap here. You're going to have order block here. And you're going to have inducement here. Are you seeing it? The first contact, when the pullback starts, the first contact is the inducement. The next contact is the fair value gap. The last contact is the order block. All of these areas are, this is called the area of interest, or the prices of interest. These are the area where you are interested in entering, right? All of these are the area. That's what I'm saying. You can start from the first one. You can start from the first one, the X, right? You can start from the first one, the X, right? And then you put 150 on this first one. Put 150 on the next one. Put 150 on the last one. Your size will differ. Why? Because you're using 10 pips. Now, at the first one, you have 10 pips. for 150. At the next one, you might have, let's say, 6 pips for 150. At the last one, you might have, let's say, 3 or 4 pips, right, for 150. What you observe is this one will have, let's say, a small lot size, like let's say 1, right? Your lot size here will be 1. That's your size. All right. This one, your size will be, let's say, like 1.75. That's what your entry will be here. Now, this one, which is the actual order block where you want to enter, you're now going to say 3 pips into 150. Your size here can be like, let's say, 6, right? About 6.00. That's what you use. On the last one, you are still going to lose how much? $500. In fact, you're losing smaller in this case. You're going to lose $450 if you are wrong. You lose $450 if you are wrong. Meaning if the market stops you out, you lose $450. But if you are right, because of this order block entry, which is 6, before the market will push back up, only like 3, in fact, only like before the market comes back with any form of reaction, you're already in profit, right? Any little reaction, you're already in profit. And now you have several positions that will ensure that you don't lose the trade. You don't close that trade without making some money. So trade management is very important. I'm going to teach trade management when we get to trade management. But I'm introducing this so that you can understand the essence of POI when I start to talk about POIs, the different types of POI and all that. Right, so POI are the areas where you are interested in entering. Let me begin by showing you what the gap is. So the first thing we know is a gap. There are several types, and I think I mentioned all the different types. Okay, there's a gap. Gap is called is the fair value gap, or you can call it an imbalance. All right, there's the imbalance. All right, the imbalance is. See, if you look at from the lowest point, all right, from a swing low or a swing high, right? The swing low or swing high, you see, you are looking for 3 bars, right? You're looking for 3 bars. Now, if I have 3 bars, what you're looking for is the second bar, right? Your eye is going to go to the second bar, right? When you go to the second bar, you want to see a gap. I'll show you. Look at what I'm saying. Let's assume that the market was going up, right? Then from here, there is maybe something, right? There's a maybe higher time frame POI or something, and it wants to reverse, right? This is the first bar. This is the first bar. And I want to tell you now that the color of the bar does not matter. Okay, that's the first bar. Now, that is the first bar. This is the second bar. Okay, this is the second bar. What do you see here? See big movement. All right. Now, I want you to notice something. Now, this is the third bar. See what I want you to notice. I want you to notice the wick in relation to the body. This is bar 1, this is bar 2, and this is bar 3. See where the wick of bar 1 stopped, right? You see it? That's where wick of bar 1 stopped. See where the wick of bar 2 stopped. Where? Here. So what do you have? See? Gap. There's a gap. What we expect is for proper price movement, everything must be mitigated. The market is going like this, and another bar wants to form, it goes like this. No matter how big it is, if the next bar wants to form, it has to first go like this, fill up that gap before it goes. If it does not fill up that gap, we say if it doesn't fill up the space here, if it doesn't fill it up completely with the wick, we say we have what? A fair value gap. If it fills it up with the wick, we say that the gap is mitigated. Right? Mitigated is just a big word that says that we have cancelled something or we have taken care of something. Right? We have mitigated it. We have closed it. We have closed the gap. So if there is an imbalance like this gap is called an imbalance, right? If there's an imbalance like this, there is a high chance, if this market continues to go down, and there is a high chance that, see, this thing is like a magnet, right? It's like a magnet. It's going to pull the price back so that it will use a wick or body to fill up at least 50% of that gap before it will continue. So that makes this gap a POI. That makes that gap a POI. I'm going to open the chart. Let me show you real quick so that it doesn't get difficult for you. See, look at the gap here. See this bar. This is the highest bar here. Right? That's the bar. Okay? And this is your order block actually. Right? The order block is the next one. After you have gap, the next thing is order block. The first one I said inducement. Then you have gap. Then you have order block. That is it. See. Look at the wick. See the wick of this bar. Look at the wick of this bar. Right? Look at the wick of this bar. See here to here. See where it stopped. Right? You can see where it stopped. It stopped here. See the next bar. You see the next bar. Push down all the way. See the next bar. What did he do? He left a gap. He left a gap. That's what we're saying. Right? So what will I say? From here now to this area is what? Is my fair value gap. And I expect it to be mitigated. Right? I expect it to be mitigated. That's where the market should reverse from. That's what we're saying. The market has to fill up that gap before pushing down. Right? And then it's everywhere on the chart. Right? And then there are places where there is no fair value gap. Right? So if there's no fair value gap, you know that, okay, there is no gap on this one. All right? There is no gap on this one. Is there a gap here? Yes. Right? From here, what do you have? What do you have here? You see, first bar, second bar, third bar. Bar 2 is the owner of. See, this bar is the middle bar, meaning this bar 2 is the owner of the bar. But when you are considering the fair value gap, right, it is see, after the extreme push, right, any form of imbalance is a fair value gap, whether it's at the extremo or is in the middle or anywhere. Just expect that the market will come back and fill it up. Anywhere you see it, there's no gap here. You can see this one covers it. This one push to this place. This one covers that place. There's no gap. See, gap here. From here, right? This who owns this gap? This is the person. That's the order block. The guy. If this is actually an area of interest, that's the guy that owns the gap. He's the order block, not this small one. This is an inside bar here. It's not it. It's this one. This is the gap. This gap will be filled. Must be filled, not must. Usually, right? Usually it will be filled. Most times it will be filled. Is there any gap here? No. Right? See it. There's no gap. You're seeing it here. There's no gap. This is the wick. This is the candle. This is the bar 2. Bar 2. See this wick. It pushed low. Then bar 2 started. This one, what? It pushed high. It covered the gap. So that this area, the market is not interested in using it. Are you seeing it? So the market continues to go down because there's no imbalance here. Continues to push down. Is there an imbalance here? Yes, right? See it ever so slightly, but it's there. Look at it. It's small, but it's there. This bar, this bar, this bar. Yes, right? There's a gap, even though this is not a proper, order block, right? But there's a gap here. Right? There's a gap. You see it here. There's a gap. See how small it is? But it's actually a gap. It's an imbalance. Right? It's an imbalance. Right? It's an imbalance. We expect the week to fill it up. All right. So that's imbalance. It's not a difficult topic, right? It's very simple. That's what imbalance means. All right. So there are other ones that we can look at. But there are other things we can look at. But I'm going to stop here. I'm going to stop here for today. So in the next class we'll continue. So you've seen the first area. You know, where everything begins from is from that pullback, right? That engineering liquidity. So it starts with the liquidity. It continues with the fair value gap, right? And then lastly, the order block. It's simple like that. Don't make it complex, right? Don't make it complex. It's simple like that. And then there are different types. There are different types, okay? And I've said this, that there are different types of POI, right? Tomorrow I'm going to look at demand. I'm going to look at supply. What makes demand valid? D to S, S to D. Valid, not just anywhere you see, strong movement, you say there is a demand and supply. No. All right, and perhaps tomorrow I can explain to you when I teach order block, I can explain to you, the concept or the idea behind the gap, right? So the gap, what causes the gap, right? What causes the gap? It is the hurriedness, the speed at which they want the market to move lower. It's the footprint, right? It's the footprint of the big banks. It's the footprint of the big banks. If the big banks want to sell, they are not selling with $10, $100, $1,000. They're selling with millions. So if you introduce that kind of money into the market does not have time to fill up its balances. It has to move very fast. That's the idea. And which bar was the last bar that experienced, which bar contains their money? That's what we mean by order block. Which bar contains their money? The next bar has a gap. This bar is the one that contains their money. That's order block. All right. Don't give yourself too much headache about the thing. It's to understand how to identify it inside the chart. That's the most important thing. But I'll still teach you the concept so that if tomorrow you want to teach people, you are teaching the right thing. You're teaching the correct thing. And you're not teaching because they say we should buy order block. Why? Why are you buying the order block? Right? Why are you picking that place as your price of interest? All right. So it's going to be up to you, right? How you manage your trade. Because I'm going to teach you, of course, the psychology behind managing the two trades differently. All right. Sometimes I use lump sum. Sometimes I use the DSA. It depends on what I have. If I cannot see a clear level, I'll just take from the liquidity area, right? I'll just take from the liquidity area, use the entire range, lump sum, right? But if I have a reason, technically, everything has to be technical. Everything has to be rule-based. When you open the trade, do not think. Don't think. You must have a rule that says this is what I would do when this happens. Write it on your sticky note. When you open the trade, it's too late. You can't think. You can't think anymore. All right? So I'm going to end the session here now. It's always nice to, share these ideas with you. I hope that, you're taking advantage of the lessons. Your assignment will be, for you to open the chart and mark for me the imbalances, right? I want to see imbalance. Right, mark it, draw it, and tell me from here to here imbalance, from here to here imbalance. Right, open your chart the same way I just showed you. Show me all the imbalances around the chart. All right, until next time, do have a wonderful time, and goodbye.